Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us. Please don't forget to like and subscribe. Click the bell so that you get a notification when we release a new video. I'm sitting today with Michael Porter again. Morning, Michael.
Morning, Robin.
Michael, investors must be really properly confused. We've told them that rising interest rates depress markets, and yet we've had 2 interest rate hikes since September, and the market has gone from 63,000 to just under 73,000. I think you're going to have to help us a little bit here.
Sure, Robin, that's a good question to start off a Friday morning.
Yeah.
Robin, I think there's basically 2 issues that are unrelated but are basically happening at the same time. So on the one hand, we have got rising interest rates, and the Reserve Bank did raise interest rates again by 0.75%. And I think you've got to remember that rising interest rates do take time to take effect. So sort of 6 to 8 months before interest rates really start to hit the economy. And I think we're actually starting to see the impact of rising interest rates on our economy at the moment. I mean, company results that are coming out are certainly pointing to things slowing down, consumers under pressure a little bit. And so there's probably a little bit more pain to come from that point of view. However, so on the one hand, rising interest rates are negative, and I think some of that impact is still got to be felt over the next sort of 3 to 6 months. But on the other hand, what's really buoyed markets is global sentiment and how that's changed. And so in the US, inflation is better than expected. That's changed the trajectory for US interest rates a little bit, and people can start to see through the top and to the other side. And then sentiment in China has changed, and obviously China's talking about opening up. It's actually, there's been a bit of a development last night with them in Chinese cases, COVID cases going through the roof again. And so they're talking about clamping down again a little bit.
Goodness.
But generally speaking, I mean, China, as we said yesterday in our Insight presentation, is just an enigma. But generally, I think the trend in China is going to be for more opening up over the course of the next 6 months, because their policy of zero COVID is just killing them, literally, not literally, but killing the economy. Apologies for that.
So, Michael, the other thing that maybe is a big factor in this whole thing is that we've seen the rand come back very strongly. I mean, we're well over the 18 now. We're sort of bouncing around about 17, just slightly under. And the oil price, Brent, has come down to sort of $85, $84 a barrel. And I think we're now over recovering on the oil price and on the South African rand by about 75 cents. Is that going to help consumers? Are we going to see petrol prices come down? Is that a mitigating factor into the economy?
Yeah, definitely, Robin. And I think the reason for the rand strengthening is just really what's happened in the US, changing inflation expectations, changing expectations about interest rates, and the dollar weakening. And you've got to remember that obviously because the dollar's been so strong, the rand is weak on the other side. So that's changing. The rand is strengthening. The oil price in rand terms is cheaper now than it was before the Ukraine invasion.
Yes.
And just to give you some color, I mean, really, towards the end of October, the price of a barrel of oil in rands was about 1,800 rand a barrel. Now it's close to 1,400 rand a barrel. So it's been a really big fall. We should see a petrol price decrease next month. But even going into January, we should see another decrease if these kind of levels hold. And obviously that will start to relieve pressure on the consumer, but it'll also start to reduce inflation, which then gives the Reserve Bank scope to stop their interest rates and say, let's pause, and the whole cycle comes to an end. So it's a very positive development. Yeah.
Michael, there seems to be a bit of a disconnect between the petrol price recovery and the diesel recovery. Is that driven by sort of Eskom burning this huge amount of diesel in the background? Where does that kind of difference come in?
Yeah, I think that's quite a difficult one. I mean, I think that's probably the conspiracy theorists sort of
minefield.
But, 10 years ago, diesel was always cheaper than petrol. And you bought a diesel car paying more up front, but knowing that the fuel was going to be cheaper. And now that's completely changed around. Yeah. I think, Robin, ultimately, there's a global shortage of diesel. And so you are paying a higher price for diesel generally. And I think there's a number of reasons for that. It obviously doesn't help what's happened in Ukraine and Russia this year. So generally, there's a bit of a shortage of diesel. Also remember that now, beforehand, we used to import crude refine our oil ourselves, and produce refined products. And now, because a lot of the refineries are shut down because they're not prepared to invest in the technology to get the fuel up to the right specs, we're importing refined product, and there's a shortage of diesel globally. So it's not to say we're going to go without diesel, but it is just a bit of a shortage, and I think there's a premium on diesel globally at the moment. Yeah. It doesn't help that Eskom's burning. I mean, they've got, 50 million litres the other day, and that's going to last in 2 weeks, It's a frightening statistic.
Yeah, it is somewhat, isn't it?
So when you fill up your car, at least you're not putting 50 million litres into it.
Absolutely. Yeah. We'll all be moving back to petrol just now.
Exactly.
Michael, thank you so much. It's great to just get some insights into what's happening out there. Thank you for joining us. Thank you for joining us. Please don't forget to like and subscribe, and we'll catch you next time.